Casey's fault. Anywho, going to be talking this week. We talked last week, gave people a little homework assignment. That's how I know tonight's going to be a short webinar, because usually when I do that, people don't listen and they don't do anything. So anyway, we talked about going through and looking for things that you see happening regularly on some charts that you study to help you find little consistent trades on. Trades like the Baidu trade that we talked about last week. And things that can give you an opportunity to just regularly produce something without actually having to make the effort of watching it and making the decision per se. To kind of give a lead in with that, I was going to talk a little bit about the Baidu trade that I presented to everybody last week. That I've been doing this one for a while, but a really funny thing about how I started doing this trade, it was actually quite simple. Over the process of studying the Baidu chart, I found that in the average week, it moves $18 from high to low. That's the average week. It doesn't do it every single week. But an $18 move from low to high, high to low, however you want to say it. Now, when I saw that it averaged that much, I wasn't really concerned that there would be weeks where it didn't get that. Because obviously, if that's the average, there's also weeks that it exceeds that. But I wanted to start finding something I could do that would hit with regular consistency. And I tried little things with it and tested the consistency of it. And, I found, just for example, that if on Monday I buy no more than $9 out of the money for the following week's expiration, some weeks, depending on what time Monday I buy, I can get as cheap as 75 cents, but usually, it's usually right in that $1.20, $1.30 range that I'm paying for contracts. Now, I don't even have to guess for this trade about whether or not Baidu is going to go up or down. What I found was, if I simply just make my buys on both sides and put a good till canceled sell order in to sell those contracts at $5. I mean, let's think about that. If I'm buying even at $1.40, $1.50, we'll say $1.50, and I get to sell that at $5, what percentage return am I making? What percentage gain am I making on that one side? $233. So if I do it as a strangle trade, and of that 233%, 100% is assumed to be the other side of it, what percentage am I making? There we go. Now this is a trade that I don't even have to watch it. I really don't. I buy it. I set a good till canceled sell order. And then see you later. Now, through the process of studying it, there's a reason I didn't go $18 out of the money. Remember, it's a move that is quite literally, I mean, you look at a lot of these, some of these candles don't have wicks on them. You look at this great big one here. It closed the week at the high, which means it took every minute from the open Monday to the close Friday to do it. that's actually why I go out the following week. Going out that following week makes it so I can get a little bit extra as a percentage of return without putting myself in a scenario where the time decay basically eats away all the profits. But the cool thing about it is, quite literally with this particular trade, I buy it, I set good till canceled sell orders, and quite literally, over 75% of the time, my sells hit. The funny thing is about 25% of the time, both of them hit. That's actually a really funny thing. For instance, one time that it did it was several weeks back, but right here, I didn't get right at the open, but shortly after the open Monday, it had dipped a little bit. And as it started coming back up, I actually bought, I think it was a little high actually on that one. Yeah, I bought when it was 223.91. And during that week, I hit the $5 sell. Well, the next week, I hit $5 on Wednesday of that next week. That's pretty cool. Yeah, that was one instance. It happened that way down here too. I was a little late in getting by. Some of the times when it's been like that, I was a little late. Down here was a time that it happened for me as well. And I had a time, there's a couple others, but very, very easy trade to do without even having to sit there and stare at it. Now, I did find that there were some times that I'd put my $5 sell order in. Last week was one of these. I hit the calls at $5. Then they went up to like 735. So of course, like any genius rocket scientist that thinks I'm a master trader and can outsmart everything, I said, well, shoot, next week I'll set it at $7. You know, back when I was first starting to trade this, I'll set it at $7. I'll tell you what, I wasn't hitting over 75% of the trades being winners. I tried $6, I tried $8, tried $10 too. But setting the good till canceled sell at just $5, basically basing it off of just the average weekly volatility. I had a trade I could make that I didn't even have to watch. I didn't have to look at. I didn't have to make any effort whatsoever. And greater than 75% of the time, my sell orders have been hit. Now, several times through talking about this, I've said greater than 75% of my sell orders were hit. What does that imply? There you go, Scotty. That they don't always hit. You know, last week was one that we got a fill at 51 cents for the buy, and we're actually able to sell at $5. That's a pretty good one. That's one of those ones that you know, you get 3 of those, you don't care if the 4th one's a loser, right? So what do you think's probably a critical aspect of things when thinking about this type of trade? Do I say, oh man, that sounds like I could win a lot of money. I should put all my account into this every week? Is that what I should be doing? It's not even about having the money for all the trades. It's one trade. Every Monday you buy it, same amount of money. Something you don't have to think about, something you don't have to, I mean, you literally don't have to think about it. When you try to actually stare at it and trade it, you'll be the one that's like, oh man, I should sell these at $3. And then tomorrow it's like, darn it, I would have got my $5. That's what'll happen. Trust me, I've learned that on this chart. But you've got to stay consistent with the position size. That's what it means. Stay consistent with the position size. You know, it's something very, very simple. On Monday, you know, really, if you think about it, it's kind of like the SPY Day Friday trade. I have losers with the SPY Day Friday trade. Never once have I ever tried to make it sound like I don't. But it's a systematic trade that you can actually do the exact same way every single week. And if you do it with the same amount every single week, you're going to make more than you lose. So the loser shouldn't bother you any. So in a sense, this kind of trade is just like the SPY Day Friday trade, isn't it? So when it comes to very, very simple things, what do you think, if you're looking for little quirky type trades like this, what do you think is a good starting point on how to look for them? I can tell you what, if you're depending on scanners and screeners for trading, you should probably stop trading because you're completely lost. If you're actually going to waste the time to trade random stocks you know nothing about and use something just to tell you you've already missed it, you're wasting your time. I don't run a single scanner or screener. It's a complete waste of time. But it's really, really quite simple. It actually takes some time. I guarantee you, you won't be able to just start looking for something and go, hey, that sounds good. I'm just going to do it. But believe it or not, these types of consistent little quirky trades, they can become a real staple in your normal trading and organization of how you trade. A lot of traders have little nuances about how they trade certain things, certain ways, and whether you understand it or not, it works. They're happy doing it. Do you guys know anybody else that has a little quirky trade that actually works if you follow him? Does it on Apple? Yeah, Steve's little Snapple Trade or whatever he calls it. It doesn't always have to make sense, but I know when he puts it out, I follow it. I know what the results of it are, and I've been quite pleased with them. Yeah, and like I was saying a few minutes ago, the SPY Day Friday trade is actually the same type of thing as well. You know, trade a stock that's been sitting around $200, $210. It's got 50-cent increments. Expiration day, hey, if you get even a halfway decent move on it, you can make multiple hundreds of percentage profits, but it can be a little kooky in how it moves, and because it's expiration day, and man, testing and studying and testing and studying for months finally led me to the first time I traded it. Traded it for about 20 weeks before I ever did it here in the chat room, and I was ready to go with it. A good solid 9 months to a year before it was something that was like, hey, this is definitely something I want to put out to this group. It's been working good for me. It's something that can be consistent. Those consistent type trades aren't just in the little quick short round things. But I am going to go through tonight just a couple that I do. And I do them at specific times all the time. I don't always put them out because that could be confusing to, let's put it this way. Since I first talked about the Baidu trade, the same 5 to 7 people have asked me the exact same questions, probably 30 to 40 times a piece, on a trade that's simple. You buy it, you put sell order in at $5, and then you stop asking questions about it. Yet some people try to overdo it, and the reality is that type of little trade, it works well. I've got a couple little trades that I do that it's 3 different stocks that I do it on. I don't do it on them all 3, but I do it on the 3 of them depending on which one meets the criteria. It's another trade I do every Friday, and we're going to talk about this one. We're going to look at Amazon. Let me erase these little lines. This trade would actually amaze most people on how I do it, but the funny thing is, it works about, I don't know, 3 out of every 5 times I do it. And I only do it if specific criteria are met. First of all, it has to be after 2 p.m. It has to be after 2 p.m. on Friday. If it's after 2 p.m. on Friday, and I'm trading options that expire that day, what does that tell you about the risk of it? Oh yeah, just if it's Friday and they expire that day, but especially being after 2 p.m. It's a very, very high risk trade. I can tell you this much. I have never once sold this trade for a loss. Does that mean I've never lost money on it? If I said I've never sold it for a loss. It means it's expired, worthless. Because it either profits or it doesn't sell. There's sometimes, and you'll hear me say this before, or you probably heard me say this before in the chat room. If I take a trade and I say, I'm taking this really small, but I won't sell it for a loss, I usually extrapolate on that and say, it's either going to get me what I want or I'm going to lose money on it. Now, the key thing for that is when I say that with my money, I mean it. I actually mean it. It'll either get me what I was looking for, or I'm going to let it expire worthless. Because I promise you, I wouldn't say that unless I was willing to do exactly what I said. Favorite part about my job here is I say that and 30 people still go, should we sell it? Should I sell it? It moves a penny, should I sell it? It goes another penny, should I sell it now? Which hinders me from being able to put out those trades because it's like, wow, I spend so much time answering questions for trades that I've actually fully explained. So now I don't have the time to look for other ones. But this is really, really simple. When you look at the options chain for Amazon, if you want to pull it up, look at your options chain for Amazon. Look at the ones right now that expired this week. What are the increments between the strike prices? $2.50, right? So chances are, if it's like after 2 o'clock, I don't want to be buying like $5 out of the money, right? I mean, you might hit some weird random home run that you just bought these contracts for a penny, and one time you knew a guy that knew a guy that had a cousin that married somebody that knew someone that hit big on it. But if you see that 250 increment between the strike prices, what do you think is going to be a pretty crucial thing to be looking for at 2 o'clock on a Friday for whether or not you make the trade? Because I will tell you, I look for it at 2 o'clock every Friday, but I don't always make the trade. I do look for it every Friday, but I don't always make the trade. Yeah, there you go, Daniel. It actually has to be close to the strike price. It actually has to be close to the strike price. Like, let's say it's sitting at, I don't know, right now the chart's kind of wrong because it jumped up a little bit with Netflix earnings. But with that 383.43, I wouldn't be interested in that trade. I would be interested if it was like the 382.50 strike I was looking at, and it had less than 80 cents to move. Because on a $400 stock, 80 cents is nothing. Think about that. That's 8 cents on a $40 stock. That's like Twitter needing to move a nickel. Does that make sense? Actually, I guess it'd be like Twitter needing to move a dime. But it's not very hard to fathom the possibility of moving 80 cents in 2 hours, right? Or 2 hours or less. The other stipulation I have for it is they've got to be under 45 cents. So there might be something kooky on it where it's like, wow, it's within the 80 cents, but man, they want 75 cents for the contracts. But remember, it's at 2 o'clock I start looking for it. I actually find that it's usually around, I'd say the average time that I end up buying is probably 2:35, 2:45 time frame. And once I do buy it, I actually never look at it again. That's the funny part about it. You see, I buy at the 45 cents or less, and I usually buy 10 contracts. I put an order to sell two of them at $1, two of them at $1.50, two of them at $2, two of them at $2.50, two of them at $3. And then 10 minutes before the day's over, if they're in the money and haven't sold, guess what I do? Yeah, I don't want them to expire in the money. But like clockwork, $3.50. Which one did I get in? Amazon, Netflix. There's a few of them I look at for it. Google's one I do for it too, and LinkedIn. And it's, which one did I get in? $2.50. Am I in the money? Did they sell? Market order sell. No, $1. Two at $1. Well, I do 10 contracts because I'm willing to lose $450 on it, maximum. But I'll do two at $1, two at $1.50, two at $2, two at $2.50, two at $3. What's funny about it though, less than 20% of the time I actually hit the $3 sell. Less than 20% of the time. But that doesn't bother me too much because if it's going to be a winner at $3.50, I'm selling it. No matter what it's at. I don't care if it's at like, man, my thing's sitting right there and right now it's at $2.94. Who cares? Sell it. You can do the same type of thing, same type of deal with Netflix. With Google. On LinkedIn. Exact same parameters. Except for Google, I'll let it be $1 out of the money. After 2 o'clock, has to be, for all of them but Google, no more than 80 cents out of the money for the contract, no more than 45 cents a contract. And I just put it in, and it either sells or it doesn't. It's not a strangle. It's not a straddle. It's just a little quirky trade that I do. I've got some quirky trades that I trade once every 3 months. Once every 3 months, that's it. What kind of trades do you think those would be? Once every 3 months, what good's that? That's a waste of my time to even study. No, actually. Example would be like, there's a Baidu trade I do every 3 months. There's a Netflix trade I do every 3 months. It's an Amazon trade I do every 3 months. There's a Google trade that I do every 3 months. But it actually requires one thing to happen, which is why I'm excited about tomorrow with Netflix. What do you think has to happen for me to want to do this trade? Not necessarily a gap up, but it's got to have a gap. Now, I'm not one foolish to think that every gap has to fill itself. I'm not that foolish. Hopefully you're not either. Because every gap does not have to fill itself. But have you ever seen on a stock that has earnings, let me go back a ways here. A stock that has its earnings and right at the open on a gap up, people take profits. Have you ever seen that happen? Yet it actually continue upwards. Last earning, Netflix did that. It was flat for a couple days, actually the first full day of the earnings. But this trade that I do is simply based on that open price. That's all I care about is the open price. After the last earnings, Netflix opened at 414.65 and hit a low of 401.87. Now, I can't show you a 15-minute chart back from there, but the exact point it hit its low, do you know what happened where it actually started making this wick and going up? Does the same thing on Baidu, does the same thing on Amazon. A lot of the big ones you can do the same type of trick for. If you get that, you got to get a nice size gap up. Because, hey, a lot of people are going to sell on that nice size gap up, or at least take some profits. And there's not going to be a lot of buying at first. So if people are not buying and they are selling, you're likely to get a downturn. And do you know where that downturn usually goes? And it usually takes anywhere from 30 minutes to an hour and 15 minutes to do it. But do you have any clue what it does in that scenario? And I wish I had a way to show a 15-minute chart back on that day. If I used like Bollinger Bands, if I had some Bollinger Bands, what's a common setting that people that use Bollinger Bands use? Yeah, 22 will have you waiting on this one. You'll wait on this one. Use a 14 or an 11 if you want. A 14 or an 11. $11 if you're chicken and scared. 14 if you're not. You see, because you can't really see it on this one. That's not what I'm trying to show it to you on. But see, what was the last price on Netflix in the after hours? I don't have my E-Trade up with the after hours on it. Actually, I think I have it right here. Hold on a second. I have that one after hours chart I was watching Netflix on. 531.55. Okay, that means Netflix is going to come out of the gates tomorrow. If it gaps up to the same price, it just closed that. Right about where that arrow is. And when that happens, let me show you what you're going to be looking at. That gaps up, we'll say that's the first candle. Can you guys see the drawing on the screen there when I draw on it? Can you guys see it? Oh, that sucks. Hold on a second. You could see it, Moss. You could see like a bright pink circle. Yeah, no, there's a little tool that's supposed to allow me to do drawing here. Let's see if that's the button that does it. Can you see the pink circle now? No, I don't drink actually. Okay, let me just go over to the whiteboard. And is there a way I can freestyle it? Okay, so I'm gonna try to make the example off the whiteboard here as best as I can. Might be a little bit difficult. You're gonna get your open like this, like $55 above where it closed. What do you think that means in relation to your Bollinger Bands that are going to exist on your chart still from today? Right now, this Bollinger Bands kind of look like this. Yeah, they're going to come up. Actually going to start out going like this. And then it'll really quickly spike like this and do one of these. And this is going to be doing this as it does its thing. It actually takes just a little bit to really let this kind of take place. But usually what you start to get right after that open is a trade that actually requires a little bit of a set of balls. No offense to our female people here, but if I say you have to have balls to do this trade, it doesn't mean you have to be a man. But when you get your open, if the open doesn't look like a big green candle like that, but opens and starts moving negative from the opening price, that's actually the first trade entry right at the open. On a big gap up like that, how could it actually be beneficial to enter at the open? What would we be looking at entering? Puts. And when a stock gaps up $55, what do you think is going to be going on with any put strikes out there? You know, if it gaps up, calls are going to have crazy implied volatility. You know, it's going to be a little wicked. What do you think's going to happen to the puts? Any premium on the puts? Oh, yeah. Now, is it possible, though? Is it possible? Let me clear this off one time. That with your little Bollinger Bands, we'll put those back up there. You know, right now they kind of look like this on your 15-minute chart if you don't have the after hours on it. You know, and then you get the open, well, those things are going to boing. Is it possible that you see it kind of open up and might even look like it's going to be red for a second, but that it do one of these on you? That is very possible too. So that first trade, if it starts to go red from open, the reality is if you don't make it, chances are you're going to miss any opportunity to make it. Because if it does starts like this right here and it does not go up, it's actually kind of likely that it does even something like that, which is actually the reason I said an 11 or a 14 setting for your Bollinger Band, because it's your Bollinger Band that's actually going to determine your sell price or where you sell it at. Because on that big of a gap up, I'm just looking for a quick scalp. But I'm not going to put all my eggs in one basket, because I might need to buy 2 or 3 times to actually be able to make money on the trade. You see, it might actually even start out over the first 15 minutes or so looking like that right there. And this type of thing's pretty common too. And then, you know, it kind of ends up doing this and then kind of ends up doing this with like this on it. And then does this. No, you get the point though. So the longer it takes to get the drawdown on it, what can you take from that? The longer it takes to actually be able to get the drawdown, think about it. What would that mean to you? The longer it takes to get the drawdown, the less gain potential is actually there. So I give it the old college try. If and when it makes a $55 gap up, and I'm willing to lose a little bit. Why? I mean, a couple years ago, 2 summers ago, but right before we launched this chat room, I did it with Baidu on one, the exact same type of trade. I don't know if cash only was there then, but I know Nina traded it with me and Howard, who's not here right now. But it was one that gapped up like 35 bucks, went red from the open, and literally hit the Bollinger Band that same 15-minute candle. Gapped up 35 bucks, down 19. What do you think that did for options that were only $5 out of the money? Yeah, it did. I'll tell you this, it gave a little more willingness to try it again with the exact same amount of money. I've been doing it on a few of these for a few years, but with this trade, the longer it goes before it gives you a bearish signal, the less likely it is to be a good trade. So it's one, I wouldn't necessarily call it a lotto trade, because it can be pretty consistent. But you got to be prepared to jump on it. And don't be stupid enough to think it has to fill the gap. Could it fill the gap? Maybe. That'd be great. But I'll tell you what, I wouldn't be holding any of it after I hit my 15-minute, 14-setting Bollinger Band. I would not. Now, what I would not encourage if you're going to do this little type of trade is to like be slick and have your after hours already on it. Because if you already have your after hours on it, then the Bollinger Bands already did what you were looking for them to do, and you won't have a clue of where to go with it. But you can see when it gets that jump, those Bollinger Bands, basically this trade, and this actually shows you fairly decent. You see how it's actually on the third candle here where the Bollinger Band finally met the price? Do you see that? Yes, no, maybe. Well, that's why I didn't go any further than talking about 3 candles when I kind of drew out a little possibility for it. It's not a trade where it's like, I have to force this trade today. I have to force this trade today. I have to force this trade today. A lot of people wake up and they're like, I got a pulse, I got a trade. I got a pulse, I got a trade. Horrible, horrible mindset. If the son of a gun gaps up, if it goes 45 minutes, it's probably time that you are no longer in that trade. Very serious about that. You run a lot higher risk if you are. Now, a similar thing to kind of what I'm explaining at it is actually the way that fast did yesterday. Look at it. It's exactly what I'm explaining to you on how to go after it for like Netflix. Gapped up. It actually started falling right at the open. And this is where you got to have a little set of balls, because it might spike up on you too. But you're looking to take your puts right down into the upper Bollinger Band on the 14 setting. You're not trying to get that wick. You're trying to get That move right there. Does everybody see that? It's actually, I thought of that just a second ago. I was like, hold on, that's actually just like the fast chart is what I'm trying to explain. But do you see why I get excited when one goes up like 55 bucks? Because it's more likely to, from the open, get me back to my upper Bollinger Band. And to do that, something that got 55 bucks is going to have to probably fall quite a couple, a couple bucks or so, right? If it gaps up 55 bucks, I'm pretty sure 8 to 10 bucks is not crazy to think. But I'm telling you, it traded up to 531. It finished the after hours mark at 531.50. That's where it rested at 8 o'clock. That was the last trade, $531.50. But there's also a second trade I look to do on that list of stocks every quarter. Can you see what it might be? And that second trade doesn't even take more than 15 minutes either. Can you see what it might be? I get this candle. And then I dead cat bounce it. But see, during that time period, your implied volatilities are going to be wacky. They're going to be wacky. So you don't want to go, what if, oh, shoot. Okay, yep, I'm a great trader. I held through a lower low and man, okay. That's not what you want to do. If there's another trade to be made on it, by this time, your implied volatilities are really going to settle down and you can take the trade on it. It is just a scalp trade. Like, quite literally, my first half hour tomorrow, I already know what I'm looking for. I already know how much I'm willing to risk on this trade. It either happens or it doesn't. And if and only if it happens, I take the dead cat bounce trade. I love the after earnings trade. Little quirky trade, but it works. What do you mean? How far down on the dead cat bounce do I play? I mark the candle bodies for my dead cat bounces. No, Richard, when that candle closes, I mark the dead cat bounce. If the next candle starts going green from the open, I buy calls. I do it almost like I used to live trade the Fannie Mae and Freddie Mac dead cat bounces. On Netflix and Amazon and them, I usually trade like $5 out of the money. Yep. Now, there's a reason why I'm explaining this trade right now. There is a reason I'm explaining this trade right now. Because I'll tell you what I won't have time to do. I won't have time to do that. I will not have time to do that. Yeah, you will never stand a chance in scalping following somebody else. You're absolutely right, Leonard. If I made that first here, if we started out tomorrow like this, well, I can't even watch the chart now because I got all these orange flashing lights all over my screen. And then it's going to be like, so yeah, that's why I'm taking the time to explain it. I use the exact chart you're looking at right now. I'm not trying to see, I'm telling you what, if you think you can scalp and say, what if it goes lower? What if it goes lower? You might be broke soon. You're not a scalper. If I get a red candle on the first candle, I'm going to hit my 15-minute 14 setting upper Bollinger Band. And I'm going to sell it the second it does. If it goes lower, oh well. Next quarter, I'll do the same damn thing. That's all it is. Little quirky trade that works. Oh, I do wait a second. Because many times, like on this gap up for fast yesterday, it gapped up and it actually ran to 42. And I wait, if it does that, I wait for it to lose the opening price. And on fast the other day, it moved fast, didn't it, Michael B? It moved fast. It opened, it ran to 42, and boom, quick. And by the time somebody's going, should I buy that? Which one is that? How much did you pay for it? I've already sold it. I've already sold it. You know, if you looked at fast down on the 5-minute to see how that move took, quite literally, let me put it over on the 15 one more time. The cross price was $40.50, we'll say. What it had hit it at was the wick of the second 5-minute candle, which was only about 6 minutes into the day. Trade over. Trade over. 6, 7 minutes in. You're done. Don't be the one that's still holding your puts all the way up here. But this is quite literally a trade. You don't force it. It either happens or it doesn't. But on highly traded optionable securities, when you get that earnings gap up, you very consistently get that. It's very consistent. I believe even INTC might have done it today, but I might be mistaken. Hold on. See, on it was the second candle from where it started going. But see, this is where you kind of have to have a pair. Just open it up and it started falling. What? Might not have been a big scalp, but what did it do? You see what it did? There was no. Well, I guess I'll wait till the next candle. It hit it. Now you just had to decide from the open if it was worth trading for 30 cents, 20 cents. Is an options trade worth making if there's only a 20-cent opportunity? And I know hindsight traders will be like, but what if it goes and fills the gap? You hold for the what if it fills the gap. I'll sell when it hits the Bollinger Band, okay? And we'll do that on every single one. And we'll see how many you sell compared to how many I sell. With a scalp trade, you got to understand, you can't think about it. There can't be like, should I buy here? Should I buy? Shoot, I should have bought there. Okay, I'll chase it. Crap, I bought it right when I should have sold. If you think like that when you're trading, you're best off to just realize that you have no chance scalping. And I mean that in the most positive way so that you don't lose everything you have trying to do something you're not equipped to do. That is in no way being rude, because here's what can happen on this trade. Look at it. From the open, you had a little dip. Oh, it did hit the 14 upper Bollinger Band. But even if you would have waited for this, look what it, okay, it kind of got there before it jumped up again. Once you are inside the Bollinger Bands, that trade's over. Once you are inside the Bollinger Bands, that trade's over. Look for another way to trade it. Once you're inside the Bollinger Bands, that trade is over. At least not that day for a scalp, right, Leonard? I mean, Netflix had a nice gap yesterday. It gapped up. Look what it did. It bounced right off the 14 upper Bollinger Band. And then it ran again. Look at this gap up. It gapped up. It came right off the 14's upper Bollinger Band. And then it did something else. The trade I'm talking to you about is strictly a gap up trade. Do you guys understand that? These are quirky little trades that you're only going to see when you gap up or gap down. I mean, even over here, look at that. Even when you just had a big run. Oh, it had a big run. I have to play puts, right? Because everybody likes to call the top of everything. It hit on your Bollinger Band, went flat before it went up again. Big board stocks like the 14 setting on a Bollinger Band. A 20 is irrelevant. You have a lot more consistency with the 14. Believe me, I learned that lesson at the cost of a lot of money. But what kind of trade is this that I'm discussing? It's not necessarily just an after earnings trade. If I get a gap on Facebook any given day that exceeds the Bollinger Band, I'm likely to at least get a scalp down to the Bollinger Band. It's just up for me, or up to me to determine if it's worth actually trading that move. That's what a lot of people don't realize. It's like, I look at plenty of stocks and say that'll go up or that'll go down, and I'll be right, but doesn't mean it's worth trading that move. Any others that have gapped up like this week, made a nice gap up or gap down, do you guys know of? There you go. I mean, LinkedIn had a gap. But if you see from where it gapped up to, what did it do? It actually put a wick right down on that 14, so it wasn't worth trading. Before it ran up. The ones that are going to be worth trading are going to be the ones that gap up, like here's your Bollinger Band and here's your gap. Ones that it's going to take a candle or two to at least catch up to it, even if it goes sideways. But if you're still holding it, when it catches up to it, you are not trading at all what this little trade would have been discussing. Do you understand that? What's funny is it actually kind of works pretty effectively on the SPY too. It doesn't mean every gap up's worth trading, but the big gap ups, it gives you a reference point. But the best example, as far as how you read it for an earnings play, is quite literally like the fast chart from yesterday. It moved fast, didn't it, Michael B? It gapped up and moved fast. You know, and little things like this are, you know, the reason I talk about little ones like this is it's important for you to be able to trade these yourself. Just like with an earnings trade. I mean, I made an earnings trade on fast, and hey, I really did try to, as quick as I could, tell people to put the sell order in. But if you weren't already ready to do it because you knew you had the position, you knew it was gapping up, then chances are, by waiting for somebody to say, hey, I sold it, then chances are you didn't get the same fill. Now, in that case, I actually sold it. I typed in selling it with the 180 sell order, and then boom. But within 3 minutes of me putting it in there, not even 3 minutes, it was more like 2 minutes, 180 turned into 150 or 145. Now, these little quirky trades that I'm talking about too, they're not just on the fast running crazy things. The people that only think about fast running crazy things, usually they're not here very long, because things leave them very, very fast. But there are things on certain charts that you'll find that you can trade time and time again with exceptional efficiency. Little things like your Fibonacci extensions on times when Lockheed Martin looks to be going up. If you're smart, you trade these 2 to 3 months out. Oops. If you're smart, you trade these ones 2 to 3 months out. You treat every trade like its own trade, and you buy on every single one, and you sell it at your target. I mean, like in the case of this one, you'd have had one buy here that didn't end up hitting the target. But on the way up, you had a sell here, a sell here, sell here. And people that want to go, well, what if it breaks the target? That's one of my biggest pet peeves. It's like, I put out a sell alert. Well, do you think I can get more money out of it? If I thought that, I probably wouldn't have sold it. To be honest with you, I do like money, and I'm not really one that wants to sell if I think I can make more of it. This is one I do every little fib point I can find on Lockheed Martin, and it hits target so efficiently, even when it does fail a zero line, that I never stop out of one. But I make sure to trade them all. Like right now, out of this one, still got a calls play that might end up worthless. Made decent on one puts play. Got a chance for 2 more active ones. If it goes up tomorrow, well, you know what? I'll start with a set of Fibonacci's here. And then I'll take these ones here. And I might even do another one from right here. As far as position size goes, I do these ones where it's not like a 1/3 or a full swing position. I only do the 1/3 buy. Just the 1/3 buy. It's the only buy, but I trade every set of Fibonacci extensions I can find 2 months out. A lot of times I will do 3 months out. Like if it's based off of a really long run like that, I'll do 3 months on that. And it's really easy. Once I put the Fibonacci extension on it, that's just a quick little couple day drop. This was a quick little couple day drop. Luckily, this one had monthlies, or I'd have screwed myself. It only had monthlies because I'd have been in like a weekly if they were available, and I wouldn't have profited. But I would actually put here edit property. Oops, sorry, not edit properties. Create alert withdrawing. Crosses. Sell 417 200 puts. When that alert goes off, do you think I'm looking at it going, well, maybe I can get more? Maybe I could get some more money. No. I'm saying, hey, if that keeps going down, I got 2 more trades that I'm in that it could go down for. But that one's over. Pretty simple. Little quirky trades that work a very high percentage of the time over and over and over again. Now you might say, well, Lockheed Martin, that one's pretty expensive. Okay. Coach Mike didn't start by trading expensive stocks. He started by trading cheap stocks. And you know, when you saw GE had its earnings over here, you take this little last, oops, let's get on it. Get on that little last high point, you go to this little last low point, come on up to this, and you know, had good earnings, where could I pull back to? Huh, well, if it hits that line and goes up, I'm going to buy calls. Let me zoom this in so you can see it. Now a little validation to prove that I do use this for GE. Our February after hours group, that's where we bought, was this day right here. Our very first meeting. Hey guys, I want you to put in an order for GE. Where are we going to trade it to? Well, we're going to go from here to here to here. Okay, you sure we're going to do that, Coach Mike? Well, I'm pretty sure. I don't know for sure, but we might. You know what? You could actually take on another set after that little down day and go here to here to here. Get a little gap up the next day. Man, that gap past the dead cat bounce area on that candle. Yeah, I'll take some 24.50 calls if you want. Pretty cheap at that point in time. You hit right on it. Okay, well, that would make you sell that one. Guess we could sell that one. And now, if I sold my calls, what should I do? My favorite is like if I say I'm selling my calls, and then somebody goes, I just bought puts. Why? You sold your calls. What here tells me it's going down. I might start looking for where it can go down to. You know, hey, if this pulls back again, might get 24.11. Oh, got to move that now. Let's see where it could pull back to so I can plan my trade. Okay. Well, that's definitely a visible pullback. Doesn't look like it's going to get to that pullback target. But after that good earnings, I think I'm going to have to be long on it. And I used two different fib points before, so I'm going to use the same bottoms for both of these. No, it's not really a W. It's not a double bottom. Well, I guess I can sell this one. Now, anybody that was in the February small group can sit and say, yep, those are all the targets we traded to. Look at that. Well, we keep winning on all these calls trades. Maybe it's going to go up again. Crap. Well, I just held that one. I did. This one right here was the April 17th calls that I sold it even when it popped the other day. I bought them because, hey, it's been waiting for up moves. I made all these other up move trades. I'm going to make that one. So what I'm showing you right here is not inconsistent with how people have seen me trade it. Well, you know, it still hasn't made a lower low, so Guess I should look at that. Maybe buy some more of it. Crap. Again, what I'm showing you is actually how I traded it. Right, Michael B? Those two buys. This one right here, I bought this day, and I bought this day. So I'm not hiding that. I'm not lying to that. I bought and it went down. You are darn skippy. Using that same bottom point and coming off of here, this was actually the final buy. But as we started, crap, I can't win for losing. So you know what I did here? I bought again, but I was switched out to the May monthlies. Then I also took from this to give myself a little target. And I still screwed it up. And on this day, I made the final alert on buying the GE May 15th, $26 calls. And I went from here to here to here. Now, all these ones where you got below the zero line, the targets are invalid. Why are they invalid? Because you went below the zero line. But I can tell you, I didn't stop out of them. Why didn't I stop out of them? Because it's just how I consistently trade the stock. And I told everybody in the after hours group, I said, until it fails this retest of that where the swing high line would be right here, I'm still bullish on this one. It might just be annoying us right now. And it was. Trust me, I got the emails to prove it. Well, by this time I said, man, those April calls, if they hit here, I got a shot at least breaking even on my average. Dang it, this thing's going down. Would you guys remember what I did right when GE's price was at $25.61 on 4.9? Anybody remember what I did? Few people wished I wouldn't have. I sold my April calls. And I told people when I did it, they had fallen on me, and man, it came back to my even price. So I sold at my even price. And I still had May calls in case something else happened. But because I had multiple buys on the May calls, what do I always do if I have multiple buys in a position? What do I always do? I talk about it all the time. Sell order for 100% profit on half my contracts. Why? Why would I want to sell half of my GE contracts at 100% when they're going to go up to 828% profit? Why would I want to do that? Why would I want to sell half of them at 100% when they are going to go up to 820% profit? So that's where I'll actually disagree with you. Because we had several fibs, and I said this was the time where one trend changed. You see, it's nice and even, nice and even, nice and even, pop, and then the trend changed. We had this set of fibs too. We had good reason to believe, and this was when we first started trading it in February. That was the final target. I said before the next earnings, that's my final target, 28.58. And I said, but we're not going to trade the first trade, the March calls up to that. But down here, why would I even be happy selling half my May $26 calls? Or for the after hours group, we were in the $25 calls at 100% when they're going to go up 828%. And Leonard's exactly right. If I traded everything like it was going up 828%, I'd probably go broke before I ever saw 828%. When I sold the 1/2 to free shares here, and I didn't even like physically like go, oh, hey, it's up 100%. I need to sell it. When I made the buy, I said, hey, I've now got multiple buys. What's my average? Okay, enter my sell order at 100% on my average price for half the contracts I've owned. Well, then it hit my weekly target. If that was the end result for my swing, my total swing, what should I do with my calls there? Yeah. And that's where I said, hey, guys, that other half we have, let's put a little trailing stop on them. And then towards the end of that day, I said, you know what? Let's just sell them. And in case it goes up some more, we'll take one calls play. But because it just completed my entire quarterly swing target, I'm going to go heavier on the puts because, heck, this thing probably swing down at least to retest the swing high or something. Right now, it's just kind of a little flat. With a month from today till the May options expire, and what I put into it wasn't even a third of the profits taken from the trade I sold. So the position I have is just kind of like a free ride position. Did you see, though, when I was doing, you know, it's coming off of good earnings, it was making higher highs, higher lows. Even when it come down here, I had no problem buying anytime I thought it could make an upswing. No problem buying. Does that mean that every time it's going to come back for me like the GE ones did? 2 days before I sold the GE ones, right here, the April 17th, $26 calls I was in were at 3 cents. Does that mean every time it's going to, well, hey, I've got the calls, it has to go up. Does that mean that'll happen? Absolutely not. But it's not like every time. You know, I was taking those April calls through here, but once we got a month from the expiration, it was, well, same system, different expiration. Start taking the Mays. And I can tell you this much, even if I would have lost 100% on all my April ones, I still wouldn't have minded. GE is very, very consistent with Fibonacci extensions. A little quirky trade that you don't have to try to overthink. Just trade it. It's also consistent to the downside, believe it or not. Which is why I bought calls here. But then, you know what? It dipped a little bit. It'll do that sometimes. When it came back up and dipped again, it'll hose you when you trade against the trend. Absolutely, Richard. Absolutely. There are charts that I go after all the time. Like last week, we talked about AAL, a very weird way of trading it, where on both the weekly and the daily, at a swing point, I actually take call buy, puts buy, and then I'll set conditionals for if it breaks the swing point to buy the other third in calls or puts based on what it is. So that's why last week when we had the webinar, I was talking about the AAL trade I had alerted. I'm still in that one. And on the daily, I honestly thought yesterday we were going to end up buying my second trade on it. You want to see my favorite one? This is my favorite quirky little trade. Take a look at it for a second and see if you can figure out how I might trade this one. And no, I never delete the lines. Well, this is only one of 6 different ways I trade GLD. But you go month out, dollar out of the money, strangle trade at every line. As soon as you make the buy, you set half your contracts to 100% sell, just so because you're going to have so darn many of them that it's hard to track them. But as they start selling, you'll be like, oh, okay. There's nothing really to help you with selling them, but just eyeballing it. But anytime it hits a line, any line I have on my chart, I buy a month out, dollar out of the money. So like this is a new line. I didn't make a buy off of this because it popped up and it just created this line. So if it come up to here and hit this line, I'd go month out, dollar out of the money. If it hit this line, I'd go month out, dollar out of the money, both sides. If it came up, hit this line, I'd go month out, dollar out of the money, both sides. I have found that I like to sell at these apex points. So, you know, when I got calls, the call side of things here, when it dipped down here, I bought puts and calls, you know, dropped, come back up, dropped again. Like if it came up here, I'd probably look at any calls positions that are up, and I'd sell those. It's effective. I make more money than I lose, but I do have contracts that expire worthless. But if it's effective, why do I care? Off the weekly for GLD, trade 3 months out. $2 to $3 out of the money maximum. Trade your chart patterns. Come up here. Hey, that could be a head and shoulders. I'll take a 1/3 buy and some puts. For what target? Well, I'll just run some Fibonacci's on it. If it breaks the neckline, that'll get me 101.66. That was close enough to a double bottom. Take 3 months out, $2 to $3 out of the money. So I'm already in calls to here. Well, you know what? That could be a head and shoulders. Buy some puts. But where's my calls target? 3 months out, 125.68. I can't do well with alerts on GLD here because you're talking about 20 to 30 positions open at any time. With a third of them being losses. It's consistent enough that I'm not necessarily worried about stopping out and such. Those are staple trades. I try to share as many of them as possible as alerts. But, like for example with GE, as soon as my chart stops lagging, when I do make those buys, I put out alerts that, hey, I made those buys. And then, man, if it goes down a penny from where I alerted it, here come the emails, private messages, it gets a little difficult with that. That's why the focus of this service is to teach people how to trade so they can take these approaches on their trades. Although I do think it would just be easier to finally just say, screw it, we'll just be an alert service. At least I'd have my Tuesday nights off. Tonight's Wednesday, but I'd get Tuesday nights off. And I just spam alerts all day. But you're never going to learn to effectively trade or reliably be profitable if all you're doing is following alerts. That's why I'll never do that. But what a lot of people like to do, they think that it's, they want to be traders, but they're trading with an investment mentality. Oh, I got it. I just have to watch it. I'll just keep watching it. Just keep watching it. Man, I really hope this does something. And then every once in a while, boom, yay! That's not trading. That's not trading. Trading is a multitude of things, a multitude of individual transactions. Not worrying about what if it goes for more, what if I could have got more. Planning a trade with a target and being happy if it gets there. And selling if it gets there. When you find those little quirky trades like one like a GE, I don't need to ever stop out because if I keep consistent with my system and I make every trade it gives me, though there will always be losers, there is nothing out there that says that'll give you a guarantee to never have a losing trade. Nothing exists. So don't even think it is there. Nothing exists that'll guarantee you that. And you keep plugging away. GE has always given me more winners than losers.
And honestly, I don't know. You know, Mike B, Michael C, you guys have been with me in the after hours group since the very first month of it. It's probably the one we talk about the most in there because of how much I actually trade it. I don't alert it much anymore. I mean, I used to alert GE like crazy. I don't alert it much anymore because nobody ever followed the trades. So I didn't want to waste people's time. And then after this last earnings, knowing it was going to be volatile, I started alerting it more and still nobody followed the trades. So I'll go on and find the next one. But whether it's a trade like my GE trade or my LMT trades, things that I can do over and over and over again. And for me, it's just easier to worry about selling the winners than it is to focus on the losers. Whether it's my Baidu trade that I trade the following week's expiration, $9 out of the money on Monday. Could I maybe get it cheaper on Tuesday? Like last week, you could have got calls cheaper on Tuesday? Yeah. But is there a lot of times, as you look at this weekly chart, that like here, it opened and there's no upper wick. It went straight down from there. Or even these green ones where there's barely any lower wick, meaning you didn't get much time to buy it lower. Yeah. So I buy it on Monday because it works. And I put a good till canceled sell order at $5. We came, what was it? Michael C, are you here right now? I see you logged in, but I don't know if you're here right now. I was so disappointed. We came like 60 cents away from getting the fill on the puts today. And then it started jacking around. I have trades like this on Tesla. Tesla has good consistency in the movements. It's a cult stock. You know, over the past couple of weeks, I've been sharing those trades because they work. And people have seen them work. You know, last week, we cashed out one of our calls trades 625%. The week before, 360%. They work. But that's different than Baidu. I mean, I do have one on Tesla that I enter each week, but it costs you anywhere from $3 to $4 to do it. And it can be a little pricey. No, like $2.50 to $5 max for the following week. So you're going to spend $3 or $4 for it. That's why I didn't really share this one because it's a lot more expensive than the Baidu one. But you will find little quirky nuances with a lot of the bigger board stocks based on average volatility. And where you mess up is where you try to stare at it all day long. Try to get the absolute best price because like on Baidu, I had a lot of people last week that followed me on that trade and then said, man, I sold it at $2. I was done. I thought I was going to go the other way. And I don't know. I got my fill at $5. I was happy. And I didn't care that it went to $7.35, $7.65, whatever it was. I didn't care about that. I was happy to hit at $5. That made me quite happy, actually. Trades like that exist on these stocks, but it takes some time to study to find it. And as you build that little repertoire of quirky little trades that you just keep hitting consistent, you don't need to think about it. You just trust that you do it. What you find out is everything else you do is kind of with play money that all those trades that are consistent are paying for. But you'll never find any of those things if you're somebody with a one stock account that's trying to trade 50 stocks. Or if you're not somebody that or if you are somebody that has zero respect for your money, so you put no effort into it. If you take the time to truly study what happens on a regular basis with these things, you're actually going to find yourself quite pleased with how easy it can be. So, what ones did you guys find to talk about? So I decided to go a little longer and talk about a few of them I do. And then the ones that you guys found, I was going to do some research on. And that'll be next week's webinar topic. Or as it seems, a week off for me.